Welcome to the deep dive. If you're here, you want the shortcut to being well informed. And today we are tackling a topic that sounds like it belongs on a futuristic newsreel, but is, in fact, an imminent economic reality.
That's right.
We have a heavy stack of sources today focusing on the large-scale deployment of AI-powered humanoid robots and what this technological shift means for corporate profits, market dominance, and, frankly, corporate survival.
And it's so tempting to view this,
Right.
the arrival of bots like the Tesla Optimus as just the next step in industrial automation.
Little efficiency boost here and there.
Exactly. But the analysis we've synthesized for you today suggests something far more revolutionary. I mean, our sources don't mince words. They're calling this a massive game changer that's poised to fundamentally restructure global labor economics.
And even kick off some potent system-wide deflationary forces.
Huge deflationary forces.
So our mission today is to unpack that core thesis, that securing access to this technology is not just about placing a big capital expenditure order. For major corporations, and we're talking about giants like Walmart, UPS, Ford, and their rivals, this is being framed as an existential choice.
Nothing less than buying a call option on the survival of their business.
We're going to back this up with specific numbers showing you the staggering financial arbitrage opportunity that arises when human labor costs are pitted against robotic costs. We'll show you exactly why the race to deploy these bots is already on and why, frankly, delay means obsolescence.
And the time frame for action, as we're about to demonstrate, it's urgent. The competitive stakes are literally the highest they have been since the advent of globalized manufacturing. You are about to understand why leaders who fail to grasp this shift now are facing immediate displacement.
Okay, let's jump right in. The central argument from our sources is, well, it's stark, it's uncompromising, and it's deeply strategic. The adoption of robotic labor, specifically humanoid labor that can fit into our existing infrastructure.
That's the key part, the human-designed infrastructure.
Right. It's not an option anymore. It's being framed as an urgent necessity for any corporation that wants to stay relevant. So why is the urgency around this specific type of automation so incredibly high right now?
Well, the core reason is, it's about two things: the breadth of application and the sheer magnitude of the cost difference. Our sources compare the pressure CEOs are under right now to that massive labor shift that happened over the last few decades.
You mean when Western companies started offshoring manufacturing and back office jobs to Southeast Asia and China?
Precisely. That was a game of arbitrage. It was based on geography and, human wage disparity.
A shift that took decades to fully play out. It required massive relocation of physical factories and, immense coordination costs all through the supply chains.
Exactly. This new robotic shift is that same historical displacement, but according to our analysis, it's amplified times 10.
Times 10.
Yeah. The companies that delay adopting robotics, even by just a few years, they risk being completely wiped out by lower labor costs. And unlike that last shift, where you could argue the labor supply was, somewhat elastic, here, the cost curve just collapses almost instantly for the first companies to move.
So this isn't about getting slightly better margins in 5 years.
No. This is about a fundamental, immediate, and frankly, irreversible decoupling of cost structures between the early adopters and the laggards.
So if the technology can be transferred instantly and it fits into existing factories and stores, once one major player goes all in, the entire competitive landscape is, it's irreparably broken for everyone else.
Precisely. Let's just look at the classic rivalries. We're talking UPS versus FedEx, Walmart versus Amazon and Target, Ford versus General Motors. The sources are definitive on this. The first company in any of these sectors to deploy humanoid robots at a substantial scale. They will gain a decisive and, critically, a possibly insurmountable competitive advantage.
Insurmountable?
They will instantaneously undercut the labor costs of every single rival.
Yeah.
That lets them either slash their prices to the bone or massively increase their profit margins and just choke out the competition through sheer financial superiority.
Which brings us to this critical concept of the first mover advantage. If the savings are as enormous as our sources claim, then the penalty for waiting has to be just as massive. It almost sounds like waiting to get in line for this technology is a corporate death sentence.
That analogy is pretty apt, and it's all driven by immediate supply constraints. We've established the astronomical economic value of these bots, but developers like Tesla, even while scaling up rapidly, they're just not producing them at a scale to meet the projected global demand from, say, the Fortune 500.
So how big is the gap between supply and demand?
Well, think about the global workforce that's doing repetitive tasks. It's in the hundreds of millions. Even a manufacturing line that's dedicated to producing 1 million robots a year. That's considered a drop in the bucket when you look at the labor needs of just one multinational like Walmart,
1 million robots is a drop in the bucket.
let alone the entire global manufacturing and logistics sector.
So for you listening, let's really internalize that analogy. Waiting to get in line for these robots is the corporate equivalent of trying to buy tickets to a concert months after they've sold out. The line already extends around the block and the doors are closing.
That's the strategic reality. You'll be waiting years, some projections say 3, maybe 4 years, while your main competitors are already deploying the tech, cutting their operational costs to the floor, and either passing those savings to customers or aggressively reinvesting them.
Widening that competitive gap beyond any hope of recovery.
Absolutely. The sources are definitive. If a company's CEO or their leadership team is not actively calling developers and securing their place in the allocation queue right now, they are already strategically behind.
So the mandate here, this proactive engagement, it isn't just about placing a standard purchase order, is it? It's about strategic partnership, about securing a high priority spot in line.
It has to be.
How deep does that engagement need to go?
It has to go way beyond the standard vendor-client relationship. Major corporations should be willing, even eager, to help fund the development or to co-partner just to secure that high-priority allocation.
Like a historical precedent for this.
Oh, absolutely. Look at autonomous driving. Users who bought full self-driving, that's Tesla's FSD package, they paid tens of thousands of dollars up front. And then, and this is the critical part, they provided millions of miles of real-world driving data.
They effectively funded the development and trained the entire system.
They did. So if you apply that model to robotics, a major retailer like Walmart or a logistics giant like UPS shouldn't just be a customer. They need to be a data partner.
A data partner? How does that work in practice?
It means they need to help companies like Tesla train the bots with real-world, highly specific data from their unique operational environments. This means offering up their stores, their warehouses, their factory lines as sophisticated training grounds.
So the bot needs to learn the exact physics of stocking a specific type of refrigerated shelf at a Kroger.
Or safely loading a particular pallet configuration onto a proprietary UPS truck. Or managing the precise tolerance stacking of components at a Ford plant.
And that partnership ensures that when the robots are ready for production, they are perfectly tailored to that company's needs.
And that corporation is at the absolute front of the line for millions of units. It's an investment in their own future operational excellence.
It's a mechanism to bypass the market constraint.
The strategic goal isn't just buying the robots. It's buying the data advantage and the guaranteed supply before everyone else realizes the market is completely sold out.
There was a quote in our source material that really stood out on this.
There was a particularly strong one that really should be taped to the mirror of every executive. If you don't have the foresight to recognize this opportunity, you don't deserve to be the leader of that company, and your company won't survive.
That is powerful. But it does raise a critical question for me. If this is such an obvious financial arbitrage play, the biggest in decades, as you say, what's to stop a CEO from just waiting until the technology is perfectly mature, cheaper, maybe more available off the shelf? That's usually the safer bet with new tech.
The critical difference here is the nonlinear scaling of the competitive gap. If your competitor cuts their labor costs by 50% overnight, they don't just gain a small margin advantage, they can fundamentally change their pricing model.
And the time it takes for the second mover to catch up.
It could be 3 to 5 years.
Yeah.
By the time they acquire the technology, train it, deploy it, I mean, a lot of these low-margin industries, 3 years of a 20 or 30% price disadvantage is more than enough to push the laggard into insolvency or distressed acquisition.
So the cost of waiting for maturation is market annihilation.
That's why it's a call option on survival. You pay the premium now by co-funding development and accepting some early risk just to guarantee you have access to the future.
Okay, we've established the existential strategic urgency. Now let's prove the financial necessity by unpacking the foundational economics. Because the savings proposition is so compelling only when you stop looking at the simple hourly wage
Right.
and start understanding the true all-in cost of human labor, which is almost always much, much higher than the employee even realizes.
We have to break down what we're calling true human labor costs. So let's take a common, relatively low-wage employee earning, say, $15 an hour in base wages. That's the figure the public always focuses on.
But the real cost to the employer is way higher.
Significantly higher. Once you factor in payroll taxes, Social Security, Medicare, unemployment insurance, workers' comp, and then mandatory healthcare benefits, paid time off accruals, all the expenses the company pays on top of that base wage.
That $15 per hour cost, where does it land?
It climbs very quickly to something closer to $22 per hour.
Wow, so that's a $7 differential, a nearly 50% overhead. That's the first hidden cost that companies don't really talk about publicly?
And that cost just escalates dramatically as you move up the wage ladder, especially in highly specialized or unionized environments. Our sources use the example of a $40 an hour wage.
Common for a skilled factory worker, maybe a long-haul truck driver.
Exactly. Once you calculate all those ancillary costs, the more robust benefits packages, the higher rates of workers' comp and some of those physical jobs, that $40 an hour wage can effectively cost the company $55 to $60 per hour.
So a $15 to $20 overhead, that is a massive fixed burden that companies are dealing with right now.
A huge burden.
Now, contrast that staggering $55 to $60 hourly burden with the estimated steady-state hourly cost of a humanoid robot. This is the key to the whole arbitrage.
Right. And the estimated steady-state cost for one of these bots, once production volume really hits scale, is projected to be around $7.50 per hour. And this is a critical figure that, well, it requires some nuance. We need to understand how we get to that number because it isn't arbitrary.
Okay, let's pull back the curtain on the modeling assumptions for everyone listening. How do we derive that $7.50 hourly rate?
So the model starts with a target price for the robot hardware itself. Probably somewhere around $50,000 to $60,000 once it's being mass produced.
Okay.
We have to calculate the capital expenditure, or CapEx, which is then depreciated over the expected 10-year lifespan of the hardware. So a $60,000 initial investment amortized over 10 years, assuming a typical 20-hour working day.
20 hours because of multi-shift operation.
Exactly. That yields a very small hourly capital cost, maybe $1 or $1.25 per hour.
Okay, so a small fraction is the hardware cost. What else is baked into that $7.50?
Next is maintenance. Even though these bots are designed to be robust, they'll need servicing, software updates, replacement parts like grippers or batteries, and of course energy. We'd allocate maybe $2 to $3 per hour for maintenance and electricity.
And the final piece.
The final and most critical piece is the subscription or the software as a service fee, the AI component. This fee, let's say $3 to $4 an hour, covers the continuous software improvement, the centralized training, the data services provided by the developer.
So you add up the CapEx, the maintenance and energy, and the software fee.
And that's how you get to the projected steady-state operational cost of $7.50 per hour.
That level of detail makes the comparison so clear. You're comparing a human cost of $22 or even $60 an hour to a highly reliable robot costing $7.50 an hour. The difference isn't marginal, it's a chasm.
And this leads us to the real aha moment for the listener. It's the simple savings rule of thumb that makes the whole proposition so easy to grasp.
Now, this rule was described as brilliantly simple in our sources. But before we get to it, let's inject that necessary complexity. If the savings rule is so simple, what are the hidden costs or operational hurdles we need to look out for that might complicate this?
That's a crucial point. We have to remember that the $7.50 only covers the robot. It doesn't cover the initial infrastructure investment needed to integrate, potentially millions of bots into legacy IT systems.
Things like charging stations, setting up the data pipelines.
Right, or the specialized human oversight you'd need for the robotic fleet manager roles. These investments do slightly reduce the short-term ROI. But the savings rule holds true because these integration costs are really minor compared to the persistent, massive recurring cost of human labor.
Excellent context. So assuming that integration is feasible, what is the simple savings rule of thumb that's derived from these figures?
The rough rule of thumb, based on these net costs, is this. As a rule of thumb, if you're paying an employee $15 an hour, you might be able to save $15 an hour by going to robotic labor.
So if you're paying $40 an hour,
you might be able to save $40 an hour. The hourly wage itself becomes the approximate net savings realized by the company.
And the reason this rule works, even after we factor in the $7.50 robot cost, is because the savings you realize, that $15 or $40 wage, is so large, it just effortlessly covers the $7.50 operational cost.
And it covers the entire $7 to $20 in ancillary benefits and taxes the company was paying on the human worker.
It's a perfect financial arbitrage opportunity.
Exactly. The human wage savings pays for the robot, and the human overhead savings covers everything else. It's an elegant, self-funding savings model.
So now we can move beyond the hourly rate to the lifetime value and potential pricing of a single bot. This really clarifies the scale of the investment that's justified. Our model assumes one bot can effectively replace 3 human shifts.
Right, working about 20 hours a day over a 10-year period.
And that 20-hour workday is the game changer.
It is. Humans work 8 hours, requiring 3 separate shifts plus all the management and turnover costs. A robot just needs a few hours to charge. So let's look at the 10-year, 20-hour day savings figures our sources calculated.
Okay, for replacing a low-end $15 an hour worker, the 10-year savings per bot comes out to $615,000.
And if that bot is replacing a higher-paid $40 an hour factory worker, the lifetime savings just skyrockets to $1.64 million.
Wow.
That is the value proposition the CEO is looking at for each individual machine they deploy over its lifetime.
$1.64 million in potential labor savings from a single machine over a decade. This makes it so clear why securing a supply of these is an existential choice. So how do we translate that massive savings figure into a justifiable purchase price for the developer?
This is where we justify the 50-50 savings split. And the question is, why 50-50? It's based on industrial precedents where a new technology offers transformative efficiency. The provider and the adopter often split the value generated to reach a market equilibrium.
So the provider, like Tesla, wants maximum revenue to fund R&D and scale production.
And the customer wants a fast, guaranteed return on their investment. 50-50 is a common mechanism in B2B disruptive tech pricing to ensure both parties share in the immense value creation.
So using that $1.64 million lifetime savings and splitting it 50-50, what price should a company be willing to pay for that technology?
Based on this model, a company should be willing to pay up to $820,000 for a single bot that replaces that 40-hour employee. Even the bot replacing the 15-hour worker is worth over $300,000 in purchase price.
And that highlights 2 crucial points.
It does. First, the return on investment is generational, which confirms the immense strategic value. And second, even if the developer prices the early models at, say, $200,000 or $300,000, which is far above that projected $60,000 steady-state capex, the ROI for the customer is still immediate and massive.
Okay, let's apply these foundational economics to specific industries, starting with manufacturing. And we have to start with Tesla. It's the perfect case study because they're uniquely positioned as both the producer of the tech and, crucially, poised to become one of its largest customers.
Tesla provides the absolute ideal model for understanding how you can use this for simultaneous cost reduction and capacity expansion. And how that leads to an insurmountable competitive advantage. Let's use their Giga Texas factory as the scenario.
Okay.
It has approximately 20,000 employees. The annual labor cost for that one facility is estimated conservatively between $1.1 billion and $2.3 billion.
A huge range, but a massive number either way. So let's explore the first of the 2 major strategic paths, focusing purely on cost reduction by replacing existing human workers.
In this scenario, Tesla decides to replace 10,000 workers, so half the Giga Texas workforce. Because of that 3-shift advantage, the robots working 20 hours a day, they only need about 3,333 bots to achieve this.
So 1 bot for every 3 humans.
Right. And given the high wages in manufacturing, this single action generates between $500 million and a full $1 billion in annual labor savings for just one factory.
That is a colossal reduction in OPEX. If Giga Texas is producing, about 500,000 vehicles a year at its current capacity, what does that saving translate to per vehicle?
It translates to a cost saving of at least $2,050 per vehicle.
Wow.
So if the average selling price of their vehicles is, say, $35,000, that is a 6% direct reduction in manufacturing cost. And now Tesla has an immediate strategic choice. They can pass that on, reducing the cost of their cars by 6%, becoming an even more aggressive price leader.
Or they can book that entire $2,150 as pure operating profit and massively improve their already healthy profit margins. This is how you widen the moat.
Exactly. But the second scenario, capacity expansion. Our sources call this the real competitive killer. Here, instead of replacing current workers, Tesla uses the robots to double production capacity without adding substantial human staff.
So they keep their 20,000 workers.
They do. They maintain their current workforce, but deploy robots to add another 500,000 vehicles in annual capacity. That brings the total factory output to 1 million vehicles. To do this, they deploy roughly 6,667 robots, which costs them an estimated $233 million a year in operational costs.
And the financial impact of that rapid automated expansion is just immense.
The strategic value here is staggering. Total net income for that factory model, instead of the initial $1.75 billion, it jumps to an estimated $5 billion. Net margins rise from 10% to 14%. The incremental net income increase is $3.3 billion, almost entirely driven by the robotic efficiency and just utilizing the existing Factory 257.
This proves the competitive advantage isn't just making the existing product cheaper.
No, it's about enabling production scaling faster than any competitor could possibly manage with a human workforce, which requires these massive, costly, and very slow hiring campaigns.
Which allows them to just grab market share at an accelerated rate while simultaneously reducing cost. It's a financial feedback loop that no competitor can match.
And we have to mention the compound effect. Robots mitigate the massive turnover costs that are so common in manufacturing. And on top of that, as the entire supply chain automates, Tesla's component suppliers will also be able to pass on savings, further driving down overall costs and amplifying the deflationary effect on the final car price.
Now, let's contrast that dynamic with the vulnerable competitors in legacy auto, Ford and GM. They have enormous labor cost problems, but they don't have an in-house robotics program.
And their vulnerability is acute. Both Ford and GM operated significantly lower gross margins, around 14%, which is already below Tesla's. Their cost structure leaves them with razor-thin net profits, often just 3 to 5%.
They're classic low-margin, high-volume businesses.
Which means they will disproportionately benefit from any cost reduction. But they face this dual challenge of lacking internal capability and the supply constraint we talked about.
They don't have their own Optimus program. They're already struggling mightily to execute the EV transition, and now they're years behind in advanced robotics R&D.
Correct. Their inability to scale production rapidly and match these cost reductions through automation puts their long-term survival at extreme risk. They are completely reliant on external vendors for the technology that is now the main driver of competitive pricing.
And because supply will be so constrained for years, they might be waiting in line behind other industries, logistics, retailers who were smarter and helped fund the development from the start.
Their survival hinges on proactive engagement they should have started 5 years ago.
So it seems like, for Ford and GM, securing an early allocation of humanoid robots isn't about improving shareholder returns in the traditional sense. It's about preventing extinction.
That's the strategic difference. Tesla uses bots to expand its margin and capacity moat. Ford and GM need bots just to stop the bleeding and avoid being completely undercut on price. They're in a desperate race against the clock, and the strategic failure of not developing their own AI and robotics capability is now an operational failure that threatens the entire enterprise.
Let's shift focus now to sectors where labor costs are the dominant operational drain, often hidden in these massive SG&A expenses. This is where the simple arbitrage opportunity shines brightest. High volume, low margin, high turnover jobs.
The retail sector, Walmart, Target, Kroger, is the prime target. And it's because of the sheer volume of employees and the staggering rate of labor turnover. Let's just start with the scale of Walmart. They employ 2.1 million people worldwide.
And their operational drain begins not just with wages, but with this shocking hidden cost of turnover.
The turnover figures they're staggering. Annual turnover at Walmart stores is estimated conservatively between 50 and 70%.
50 to 70%.
So let's take the mid-range. They have to hire and train over 1 million people every single year just to replace the ones who leave. And if we assume a conservative $5,000 cost per hire, which includes recruiting, background checks, onboarding, training time, Walmart is spending at least $5 billion annually just on turnover and training costs.
$5 billion, and that cost is completely non-value add. It's just waste.
It is completely eliminated by a robotic workforce.
$5 billion just to manage a revolving door workforce. That figure alone should shock any executive into immediate action, and that's before we even count the direct wages. So let's look at the direct labor savings potential from the Walmart impact analysis.
Okay, Walmart's total annual labor costs are approximately $122 billion. Our analysis shows the savings potential even with just minimal adoption. If they replace just 10% of their workforce, that requires only about 60,000 bots.
And that's factoring in that higher 3.5 shift replacement potential, because stocking shelves and moving boxes are ideal repetitive tasks for a bot.
Exactly. This deployment generates a staggering $8 billion in annual labor savings.
$8 billion in annual savings from replacing only 10% of their workforce. That's a powerful ROI, but what does that do to their bottom line?
Well, Walmart had approximately $28 billion in pre-tax income over the last 12 months. Saving $8 billion represents an almost 30% increase in pre-tax income.
30%.
If they could maintain constant revenue and shave $7 billion off their operating expenses, they would effectively double their operating profit. This is why robotics isn't a luxury upgrade for them. It's low-hanging, mission-critical fruit for profitability.
And the path to doubling profit for the whole retail sector across the entire competitive landscape, it's pretty clear based on labor intensity.
It is. Our data shows that to achieve a 100% increase, so a doubling of pre-tax net income, Walmart would need to replace about 35% of its workforce with bots. Target, which has slightly better operational efficiencies, needs about 30% replacement.
And Kroger.
Kroger, which is extremely labor-intensive in its store and perishable management operations, needs only about 20% replacement. The simplicity and repetitive nature of these tasks means that assumption of one bot replacing 3.5 workers is a very realistic near-term goal.
And this highlights an interesting ethical point. The jobs being automated here, stocking shelves, assembly line work, moving packages, these are the boring, repetitive, high-frequency jobs that humans inherently dislike.
Which is precisely why the turnover is so high. Robots are perfectly suited to these tasks, 247. It's the perfect symbiotic use case. Jobs that are expensive to maintain because of human attrition and inconsistency, but that demand high operational frequency and need to fit into existing store infrastructure. The bot doesn't get bored. It doesn't burn out.
Let's pivot to logistics, a sector dominated by UPS and FedEx. This sector deals with the massive cost of distribution and the high salaries and benefits that come with unionized drivers and sorters.
UPS is an immediate case study in labor expense vulnerability. Their compensation and benefits expense totals an astonishing $12.1 billion per quarter on $21 billion in revenue. That single line item is over 57% of their total revenue. And critically, their net profit margin is only 6%, which results in about $1.3 billion in quarterly profit.
So, just to put that into perspective, their quarterly cost to employ humans is nearly 10 times their quarterly profit.
Exactly. If UPS could save just $1.3 billion of that $12.1 billion, which is about a 10% reduction in labor costs, they would double their profitability.
Double it.
This just underscores how utterly critical automation is for their survival, especially with the continuous pressure from wage negotiations. They desperately need both humanoid robotics for their sorting and distribution centers and fully autonomous transportation for trucking and last-mile delivery.
Now, Amazon is often cited as the logistics automation leader. They already have over 1 million industrial robots. Do they still need humanoid robots, or is their automation problem basically solved?
Oh, they absolutely still have a massive need. Industrial robots are great for large-scale, predictable, repetitive movement in these highly structured, often custom-built warehouse environments. But Amazon still faces the monumental last mile and last few feet problems.
What do you mean by that?
I mean, getting the package from the truck to the door. This requires the versatility of a humanoid form factor. Navigating unique customer porches, dealing with steps, gates, driveways, and delivering the package safely, that requires complex dexterity, balance, and spatial awareness.
Things a general-purpose humanoid robot is designed for.
They need a machine that can adapt to a chaotic, unstructured environment. The real world. The humanoid form factor is a bridge between the highly efficient but inflexible automation of the warehouse and the chaotic environment of a residential street.
Okay, finally, let's briefly touch on food service, using a company like Chipotle as a proxy for the entire high-turnover restaurant industry.
The labor cost structure in food service is often just financially unsustainable relative to the profit. Chipotle's quarterly labor expense is approximately $800 million. Compare that to their net profit, which is only about $400 million.
Their labor cost is double their net profit.
Double. If they could realize that simple savings, rules saving roughly half their labor costs through automation, their profit would double instantly.
And yet again, this is a sector that's defined by massive human turnover in highly repetitive, boring jobs, preparing bowls, assembling sandwiches, frying potatoes. It's an environment where the inconsistency of human labor directly impacts food quality and wait times.
The compounding issues of massive turnover, the cost of continuous retraining, and the inherent inconsistency of human performance in these tasks. It makes the robotic solution an immediate financial imperative across all of these low-margin, high-volume sectors. Companies are paying millions, sometimes billions, to manage a workforce that is inherently inconsistent and expensive to retain, all while dealing with continuous labor scarcity.
We focus so much on the balance sheet and the immediate corporate survival math, but the implications of this technology extend far beyond just optimizing SG&A expenses. This is about reshaping the fundamental cost of living globally.
This is the macroeconomic shift that makes this so fascinating. The widespread adoption of humanoid robots is the first component in what our sources describe as the triad of deflation.
The triad of deflation.
Three enormous forces converging at the same time to create massive deflation and significantly lower the cost of living across the globe.
Okay, let's detail this triad. What's number one?
Number one is the force we just analyzed, near-zero labor costs, enabled by AI-powered humanoid robots, replacing humans in nearly every non-creative, non-complex task across manufacturing, logistics, retail, and service.
And number two?
Near-zero energy costs. This is being driven by the rapidly scaling deployment of solar power and massive battery storage capacity, which makes energy production cheaper and less volatile than it's ever been. This removes another enormous input cost from the global economy.
Okay, number three?
Near-zero transportation costs, achieved through fully autonomous robotaxis and trucking. Removing the driver, the most expensive part of the logistics chain, slashes the cost of moving goods and people globally.
So when you combine those three elements, labor, energy, and movement, the price of nearly all manufactured goods and services just collapses.
Prices will fall precipitously. The simple examples really illustrate the magnitude of this. The price of a banana could drop from $1 to 10 cents because the labor to pick it, the energy to transport it, and the human cost to stock it all approach zero.
And for a more complex product?
A bicycle that costs $200 today could cost $25. This massive deflationary pressure, while it's challenging for current inflationary monetary policy, will raise the standard of living by making core necessities vastly cheaper and more universally accessible.
But I have to insert a critical check here, as we promised. The triad sounds almost utopian, but are there inherent conflicts or complexities in getting all three to converge at the same time? For instance, if you have millions of robots working 20 hours a day, the demand for stable electricity is enormous. How does near-zero energy cost, driven by intermittent solar power, ensure the grid stability you need to run this robotic workforce?
That's where the complexity truly lies. Near-zero energy only works if we have near-perfect grid stability. And the transition to solar and battery storage introduces intermittency problems. So the deployment of humanoid robots at scale actually mandates a simultaneous massive investment in utility-scale battery storage, like the projects being built by companies like Tesla and others.
So the robots become a driving imperative for completing the energy transition.
Yes. They can only achieve that 20-hour uptime if the grid doesn't fail, which means the energy storage component of the triad must keep pace with the robotic manufacturing component. If one lags, the competitive advantage of the 20-hour workday just evaporates due to downtime.
That makes the energy transition an operational necessity for the robot revolution, not just an environmental goal.
Exactly. And the cost savings from the robotics provide the financial incentive to rapidly fund and deploy the necessary grid upgrades and storage facilities.
Okay, let's return to the corporate perspective and discuss the qualitative edge. These are the advantages of a robotic workforce that are often impossible to quantify in traditional financial models, but they represent enormous hidden costs for any human-run business. This is the list of HR headaches that instantly disappear.
And this list is really the psychological selling point for any executive who has spent years managing personnel issues. Robots eliminate nearly all the massive company drains that management, legal, and HR teams spend their days addressing, all these costs that are currently just buried in overhead.
Let's start with reliability and retention, which gets back to that $5 billion Walmart turnover issue.
Robots are never late for work. They never call in sick. They never need mental health days.
And they're not great.
This instantly eliminates the annual turnover costs we calculated for retailers, plus all the ongoing costs associated with healthcare benefits, 401k matching, and retirement packages. And on top of that, they don't demand vacation, maternity, or paternity leave. Their only requirement is electricity and maintenance. The consistency of labor becomes a massive asset.
Okay, consistency and conduct are next. This speaks to the soft costs of management.
Robots don't fight with other employees. They don't require conflict resolution. They don't file harassment claims. They don't steal inventory. And they certainly don't go on strike for better wages. The amount of middle management time that's spent dealing with interpersonal conflict and minor theft costs that vanish entirely is substantial, but it never shows up as a line item on the balance sheet.
They're happy to do the boring, repetitive work 24/7 without demanding more pay.
Exactly.
Now, let's move to scaling and quality. This is the competitive advantage that goes beyond cost reduction and speaks to the speed of business growth.
This is where the compounding power of AI truly shines and fundamentally breaks the human model of scalability. In a human workforce, Scaling means hiring new people who all have varying skill levels, and that requires costly and inconsistent human training, and it introduces variability into your product quality.
Right.
With a robotic workforce, once one robot is trained to be highly skilled, the best bot of all the other bots, at stacking a shelf, for example, that precise knowledge, that highly consistent quality of work is instantly and universally transferred across the entire fleet via a software update.
So every single bot immediately operates at the highest possible skill level, instantaneously.
Yes, you eliminate human variability. You don't have worker A who is brilliant and worker B who is mediocre. Every single bot operates with the precision and speed of the best trained machine. You eliminate the need for costly performance reviews, retraining programs, the constant monitoring associated with human productivity. The whole system just continuously gets better through centralized software updates, not through costly, inconsistent human supervision.
That is a complete paradigm shift for scaling any franchise, factory, or logistics operation. The CEO who adopts this isn't just saving the $15 hourly wage. They're buying guaranteed quality control and instant scalability.
Absolutely. They're saving the legal fees, the HR coordination time, the policy costs, the management overhead, the turnover expense, and they are gaining unparalleled consistency and quality, all while ensuring their cost structure is immune to inflationary wage pressures, which lets them underplace competitors who remain reliant on human labor.
But let's circle back to that necessary complexity one last time. We mentioned the hurdles of IT integration. It's one thing to calculate the savings. It's another to physically integrate millions of highly complex AI hardware units into decades-old legacy IT systems at a company like Kroger or FedEx. What are the material integration hurdles that could slow down or increase the actual deployment cost?
That is the single greatest short-term headwind. Legacy corporations often run on enterprise resource planning ERP systems that are decades old, and they were designed around predictable, finite human work schedules. Integrating a continuously learning AI fleet requires a fundamental overhaul of their entire digital backbone.
What does that mean in practice?
We're talking about massive investments in cloud infrastructure, dedicated 5G or internal networks for real-time data flow, and specialized digital interfaces that can manage dynamic scheduling for millions of devices operating at varying energy levels. This complexity demands a specialized team, far beyond simple IT maintenance.
So the initial investment isn't just buying the bot, is buying the modern IT infrastructure necessary to support the 24/7 data stream that powers the bot's AI and its continuous improvement.
Precisely. You need to ensure the bot can report its status, receive real-time updates, and integrate its physical output with the company's inventory and supply chain systems instantly. Failure to invest in this digital transformation means the bots will be perpetually operating below peak efficiency, just wasting the CapEx investment. This is why that strategic partnership model works. It ensures the hardware developer is also integrating with the customer's complex legacy digital systems from day one. So to summarize the profound strategic and financial shift we've analyzed today, humanoid robots represent the first time in history that we have a form of labor that can outcompete humans on consistency, efficiency, and cost. Yet they fit seamlessly into the world we have already designed.
They are the same size as human workers, they use the same tools, and they navigate the same aisles and factory floors that were built for us.
And that is a crucial distinction that sets them apart from inflexible industrial robotics.
So the message for every executive and every learner listening is fundamentally clear. The cost of labor is about to become a decisive competitive advantage, just as it was when manufacturing moved overseas, only this time, as you said, amplified times 10. The data shows that failure to secure early allocation now, by investing and co-partnering during the development phase, is a failure of corporate foresight that gives rivals a multi-year, potentially insurmountable head start.
Especially if they're operating in a low-margin, high-turnover industry like retail or logistics. The simple rule of thumb, that the dollar amount saved roughly equals the hourly wage paid, is already compelling enough to justify the investment. But let's leave you with this final provocative thought, something for you to mull over in the context of your own operations.
Go on.
Considering the staggering unquantified costs we reviewed, the $5 billion spent annually by Walmart just on turnover, or the potential for UPS to double its profit by eliminating just 10% of its massive labor expense, what unquantified hidden costs are your company incurring right now?
Think about the legal issues, the internal coordination time, the policy costs, the training inefficiency, the lack of consistency.
These are the costs that a robotic workforce will instantly eliminate. How much is that qualitative advantage alone truly worth to your business today? And how long can you afford to wait while your competitors buy that advantage?
Something to ponder as the robotic revolution accelerates from science fiction to economic reality. We'll see you next time on The Deep Dive.